I'm Jason Bratz. I'm going to cover a little bit about bonding this morning. Don Miller from the Braemar Agency as well is going to talk about the insurance requirements for Travoux and a little bit for the Housing Authority. We're going to give you probably more information on bonding than what you need to know right now, but it's going to be useful here. So bonds are a little bit like a Swiss Army knife. They do a lot of different things for a lot of different people depending upon what you're looking for. They guarantee in some cases, and I apologize for the formatting issues. Everything's fine on my laptop. It's not fine on the screen. But they guarantee projects get completed. They guarantee that bills are paid. They guarantee that wages are paid to unions in some cases for wage and welfare bonds. So bonds are literally like a Swiss Army knife. They do a lot of different things. Bonding in its simplest form is unsecured credit. Everybody gets what secured credit is, right? You buy a car, the bank holds the note on your car. If you don't make the payments, the bank comes and collects their car back. That's secured credit. The bank is secured on that car. You can't transfer that car until the bank's paid. With bonding, it's unsecured credit. That means there's no hard assets necessarily backing it. If a contractor would fail on a bonded project and go out of business, people are going to show up that want to get paid. Number one are the employees. The employees are the first to get paid always. They're going to get paid back wages, vacation, any sort of pension contributions for union contractors, different things like that. Anything they're owed, the employees are going to be first to get paid. And then the secured creditors show up. They're the ones that hold the assets because they have a bank line or credit out there. They're going to show up and they're going to say, okay, we're going to take the building or the excavator or whatever it is that they're holding, and they're going to get made whole. And at the bonding company, at the end of the day, when everybody else has been paid, they get to show up and say, okay, what's left? And a lot of times it's a pile of smoldering ashes. There is nothing left. So the bonding companies aren't secured. They're at the bottom of the food chain when it comes to collecting in the event of a claim. There's three parties involved in a bond. Number one is the obligee, which is the owner, Travoux in this case. The surety, which is the bonding company, and then the principal, which is the contractor. And the contractor has a contract with the owner saying, we're going to build a building. That's what our contract is, or we're going to put a pipe in the ground, whatever the contract is. The owner has an understanding with the bonding company because the contractor will provide bonds that, hey, if the contractor doesn't finish the project, or if the contractor doesn't pay all the suppliers on it, we, as the surety company, the bonding company, will pay all that stuff, Mr. Contractor, Mr. Owner. We're going to take care of that stuff and build the building and pay people. And then the bonding company has an agreement with the contractor that says, hey, we're going to provide unsecured credit to you. However, if we have to pay out on a claim, Mr. Contractor, you're going to pay us back. So it's a three-party arrangement. Everyone's got their own thing. And in between here, we've got the construction contract. So the most common types of bonds that we're going to see and talk about today are bid bonds, performance bonds, payment bonds, and then license and permit bonds. Bid bonds are typically 5 to 10%. For Travoux, they're 5%. For the city of Milwaukee, a lot of times for Department of Public Works are 10%. For the U.S. government, if you're bidding to the Department of the Interior or the Army, it's 20%. So it's just different. And all that 20% means is that's the penalty on the bid bond. And I'll explain how that works. If you bid to a government entity or an owner and they require a bid bond, the bid bond guarantees that if you're low bid and are awarded the contract, you're going to sign the contract and provide any necessary payment or performance bonds. Once you sign the payments and performance bonds and return the contracts, the bid bond goes away. It's gone. You shred it. It doesn't do anything anymore. If, however, you are the low bid on a project and you don't sign the contract and provide the necessary payment or performance bonds, the government can keep that percentage as a penalty. So the bonding company, just to use a nice round number, $100,000 contract, if it's a 5% bid bond and you bid the $100,000 and you're awarded the project and don't sign the contracts and provide the payment performance bonds, the bonding company might have to pay 5% or $5,000 to the owner. That's kind of a penalty. And the reason that they have bid bonds are a couple reasons. One is they want to make sure anybody that's bidding public works is qualified to do so and that they're financially solid. The other thing is they want to avoid people that can't fulfill the contract and can't provide the payment and performance bonds. They don't want them bidding projects and then get the job awarded to them only to have to go to the next bidder and the next bidder and the next bidder because the first 2 or 3 can't provide the payment and performance bonds. So it's a pre-qual to kind of weed out people that may not be able to successfully complete the job. Also, and I just saw this next door, a couple doors down, is in lieu of a bid bond, you're also able to provide a cashier's check. Here's the problem though. If you provide a cashier's check and then you find out later that you can't get a payment and performance bond, the city or whoever, the owner, can keep your money. And that's real money you've given them. So if you're going to bid a public works project or anything that requires bonding, always get pre-qualified ahead of time, because if you have a bid bond, you've got essentially an assumption and understanding with the bonding company, hey, you provided the bid bond, you're going to provide the bond now, the payment and performance bond now. Where if you give the cashier's check and you don't have a bonding company in line and you can't find one, you've essentially given them money. So there's no cost for a bid bond in Wisconsin. Some states allow minor fees. Someone way back when in Wisconsin said, hey, let's just do this for free. So we do a lot of bid bonds for free. Lots of them at our agency. We're the largest bonding agency in the state. And it's part of the deal. We just churn out bid bonds left and right for all people, all sorts of contractors bidding public works. So no cost for a bid bond, but you have to be pre-qualified to get one. We just can't turn it, you can't call us up and say, hey, I need a bid bond at 9 o'clock for a 10 o'clock bid. It takes some time to get stuff approved. Not saying it can't be done, it's just awfully tough. The other type of bond that we're going to talk about is a performance bond. Performance bond requires a written contract. The written contract's required because the performance bond guarantees all the terms and conditions of that contract. So if that contract that you're awarded is to put up a building, the payment bond guarantees that you, Mr. or Mrs. Contractor, is going to put up this building. That's the contract. It's going to guarantee the type of construction methods. It's going to guarantee the completion dates, all these things associated with that contract. It guarantees all the terms and conditions of that contract. If you fail to complete the project, and in the worst case scenario, a contractor goes out of business halfway through the project, the bonding company then has to step in, hire another contractor, and finish the job. Even if it costs them twice as much as what it was supposed to cost the original contractor, the bonding company is going to finish the project. Once they take over a project, the bonding company then gets all the receivables on that bonded project from the owner. So they're getting the payments that you would have had as a contractor. But at the end of the day, the bonding company is going to complete the project, and then they're going to try to track you down, Mr. or Mrs. Contractor, and say, hey, we paid out X amount of dollars. Go ahead and pay us back. And the likelihood of them collecting is pretty minimal. But at least symbolically, they can do that. The premium on average for a payment or for performance bond is 1 to 3% of the contract price. And we'll explain what determines the rate later. Payment bond, again, requires a written contract. Most of the time, payment and performance bonds come together. They're a pair, a match set. It guarantees a lien-free job. So it guarantees to the owner that, hey, this contractor is working on your project. They're going to pay all the suppliers. They're going to pay all their employees. They're going to pay any sort of union or pension obligations, anything like that. They're going to make all those payments so you, Mr. Owner, don't have to worry about anything no matter what. A lien's not going to happen on your project, because if it does, we as the bonding company will step in and pay everybody off to make the liens go away. So in the event that the contractor fails, the bonding company steps in and they make payments. And they don't just pay anybody. You have to prove that you provided. So if you're providing light fixtures, hey, I provided these light fixtures. They'll verify that it's accurate, that you did provide them, and then they'll write you a check for it. Anything they pay out, they're going to try to come back and get from the contractor if they can. Bond, the premium for that is 1 to 3%, but the payment performance bonds is 1 to 3% for payment and performance bond, not 1 and 3% for payment, 1 and 3% for performance. They're together, so you pay 1 to 3% and you get both of them. License and permit bonds, they're generally required by municipalities. All they really do is assure the municipality that you'll abide by all the laws, rules, and regulations associated with whatever permit you're asking for. So if I apply for a permit to demo a building, there's certain laws and rules that I have to follow in the city of Milwaukee. I provide a demolition bond, and it's a smaller amount, normally it's $25,000, $50,000, that says that I'm going to follow by the laws and rules they're associated with this job that I'm doing. Same thing with erosion control. That means I'm going to put up the silt fence or whatever else associated with it. If I don't, they can make a claim on the bond. I don't see many claims on license and permit bonds. Indemnity agreements, largely symbolic, but this is the agreement you sign with your bonding company that says, hey, Mr. Bonding Company, if you've got to pay out on a claim, me as the contractor, I'm going to make you whole. I'm going to pay you back. It's more or less symbolic because, again, the bonding company knows if you go insolvent, they're not going to get a whole lot of money back. But at least symbolically, it says that you're standing by your company and standing behind your company, that you're willing to sign your name on the line. These agreements are not a whole lot different than you have to sign with a bank if you take a loan out with a bank. Largely the same. For our intents and purposes, there's three types of bonding programs we're going to talk about today. Standard, which is a traditional bonding program, non-standard bonding program, and then the small or fast-track bonding programs. A standard bonding program requires quality internal financial statements, CPA-prepared year-end financial statements. They like to see positive equity, so you've got money built up in the company. You've got a rainy day fund essentially built into the company balance sheet. Positive working capital, so you're making enough money to cash flow your work. Stuff like that. The rates tend to be lower in a standard program, and the bond capacities tend to be higher because the bonding company can see what you've got. You've built up a good equity. You've built up positive working capital. Because they're less likely to have to pay a claim out, they ask for less premium, and they're willing to extend more unsecured credit to you in terms of bonding. But the rates of capacity are based completely on the financials, your work experience, stuff like that. Non-standard bonding program are for contractors that have some of that financial information, but maybe not all of it. Or what information they have might show that the balance sheet is a little distressed or not as robust and strong as it could be. Some of those situations may or may not require collateral. We don't do a whole lot of collateral bonding at our agency, but there are people out there that have to post 20% of the contract price, and the bonding company holds your cash until the project completes, and then they give you back your money. We don't deal a whole lot with that. To me, it always seems kind of counterintuitive because you're cash strapped, right? And that's why you're in a non-standard program. So we're going to hold $20,000, 20% or whatever it is, and that's going to fix things. It really doesn't. I also see funds control sometimes. I forgot to put that on the slide, but that's where they require a third-party administrator. So the owner would make payments to the title company, the escrow company, and the escrow company would pay your supplier and then pay your labor and then cut you a check for the profit. So it's a way to make sure that the money goes where it's supposed to go. There's SBA backing of bonds. The Small Business Administration within the U.S. government has a program for bonding that if you qualify, they'll guarantee 80% of a loss to a bonding company. So if maybe your balance sheet isn't as strong as it could be, and we can get a bonding company to say with SBA support, we would support this contractor, then the bonding company might look more favorably on your account. The problem with non-standard programs, rates tend to be high, and the project size tends to be somewhat limited. So the other problem is approval time. This isn't, again, call at 9 o'clock, get the bond at 10 o'clock when you don't have the program set up. Even with the program all in place, it's probably a day to 2-day turnaround versus an hour turnaround. With a standard program before, once you have the program set up, it's 20-minute turnaround. We can pound a bond out if you're approved in a standard program. The smaller fast-track bonding program, this is where I see a lot of newer contractors jump into the bonded work marketplace. It's based solely on personal credit score. It's a one-page application. It's quite simple to do. You just have to have a decent personal credit score. It's fast approval. I can get approval in 2 hours because, again, all they're doing is running an Experian or a credit rating and the Social Security number. Rates are generally 3% of contract price. It's a flat premium. So you're going to pay 3% of that. The other trade-off is it tends to be a maximum contract size of $400,000. I can get them to stretch to 5 in some cases if it makes sense, but they're limited. There's very few people that go to $1.5 million or $1 million on a small, quick type bond program. So how bonding companies avoid claims? Underwriting. That's that simple. They look for the 3 C's of bonding, which are capacity, capital, and character. So capacity, does this contractor have the right workforce? They have the workforce. Do they have the machinery that they need? Do they have the capabilities to do it? Capital is the financial management. Contractors rarely fail in the field. Contractors rarely fail in the field. You've had contractors that were winning quality awards in the field that went out of business because they failed in the financial management of their company. This is where contractors win or lose, is in their cash flow and their managing of their capital. So they look at the cash flow, they want to look and make sure that there's adequate funding there and there's enough money within your company to fund the project. And then they look at the character. Does this individual have a history of meeting their obligations? Do they pay their bills? Do they fulfill their construction contracts? What is their character? Because you can, if you don't have the capital, but you have a good work ethic, you can figure out and find other ways to get the thing done. So character is pretty darn important in there. So for a standard and non-standard program, they're going to be looking for CPA-prepared financial statements once a year. They're going to be looking for personal financial statements, which is just, again, your personal balance sheet. They're going to be looking for aging of accounts receivable. They want to look and see how many receivables do I have that are over 90 days old? Because if you have receivables over 90 days old, the likelihood of collecting them goes down dramatically. 90 is like the Goldilocks zone. Anything beyond that, it gets awfully tough to collect. Anything under that, you still got a pretty good shot at it. They're going to look for information about what's your current work in process. So how extended are you? How much work do you have out there right now? Because we want to make sure that you're not overextended. They're going to look for information about related companies. They're going to look for other companies you're involved with. You know, restaurants and bar ownerships. That's the kiss of death for contractors because a lot of times bars don't do well, and then the construction company becomes the goose that lays the golden egg to fund the bar. So they're shuffling money to other entities. They try to make sure that if you're a contractor, you're a contractor. Past experience, and then they're looking for continuity plans as well. They want to make sure that, you know, if you have somebody that's an owner who's 80 years old that's great at what he does, but there's nobody in line behind him, and they write a bond today and something happens to that individual, then they could end up paying out on a claim. So they want to make sure there's continuity plans built into a company. So what they're looking for when they're looking at the financials is a couple ratios. They're looking for debt to equity no more than 3 to 1. Now they can step outside of that a little bit, but they want to make sure that the bank doesn't own more than 3 times more of what you do. Because once that debt to equity gets higher than 3 to 1, you're not calling the shots of your company, your creditors are calling the shots of what you're doing. They want to make sure you have working capital of at least 10% of the work on hand. Inventory, they're severely discounted. Sewer and water contractors are great because they buy 50 extra castings like manhole covers for jobs, and then they'll put them in the back and they'll call them inventory, and it looks like a huge number on their balance sheet. But the reality is that the next job they're not going to use those. They're just going to order 10 extra more for that job, and they're going to get put on the pile. So inventory gets discounted by about 50% unless you can prove that it's turning. It's inventory that's in, inventory that's out. It's not just stuff sitting in the back that never gets used. Goodwill on a balance sheet gets discounted completely because what value does goodwill have? You see that on balance sheets. Oh, look at my balance sheet looks great. Well, it's all goodwill. What is goodwill? Nobody knows. I've still not gotten a good answer. And then any receivables, like I said before, over 90 days old, they get discounted out of the balance, out of the working capital, and they get discounted out of equity. For the small bond program, what they're looking for is, again, personal credit score. That's it, personal credit score. The assumption is if you've managed your personal credit score well, that you're an honorable person, you're going to meet your obligations, you're going to protect the credit score, you're not going to step, you're going to be conservative in what you look at for a construction project. And they've got enough evidence that supports them because there's very few claims that come out of the fast track bond programs. Very few claims. I've only had one, I think, that came out of there, and it turned out to be no loss for the bonding company because they finished it. So the red flags to bonding companies, these are the things that make bonding underwriters really nervous. If I bring an account to an underwriter and there's an existing claim with their current bonding company, that's a problem because that means their current bonding company shut them off on bonds and they're trying to find a second source. Well, if that turns out to be a big claim that puts them out of business, the new bonding company is probably going to lose some money too. So existing claims is a big red flag. Attempting a project significantly larger than you've done in the past. If I've never done over a $100,000 project, and all of a sudden I'm looking at $1.5 million, that's a pretty big leap. So that's a risk factor that makes bonding companies nervous. Taking a project outside of your normal geographic territory. So if I'm a Wisconsin-based, Milwaukee-based contractor, and all of a sudden I'm looking at bidding a project in the boroughs of New York, it's a different world out there, right? You got to know who to give the brown paper bag of cash to get the job, and it's just a different environment. I don't know the players out there for contractors. I don't know the labor unions that are out there. I don't know the area, the suppliers. It's a risk factor. So sticking to your geographic area makes the bonding company a lot more comfortable. Taking a job outside your specialty. I'm a plumbing contractor. Now I'm going to do a roof. Well, what do you know about roofing? Well, nothing, but I'm a contractor. It's different. It's taking something outside your specialty. Heavy reliance on somebody with no skin in the game. So I'm an absentee owner. I'm not involved. The person that's running the company has no skin in the game, and they take risks because they don't have any skin in the game. So absentee owners are a concern. No working relationship with your bonding agent. I get a lot of calls on stuff, and the first call on the agent from the bonding underwriter is, hey, do you work with them on insurance, or how do you know about this account? They just walked in. I don't know. They called me up out of the blue. Well, do you know anything about them? No, I don't. It's hard for me to go to bat. Now, I can build a relationship and get to know them. We can fill in some of the blanks. But that's a question because, again, it's one red flag for the bonding company if their agent doesn't know them, because then I can't vouch for the character, the capacity, the capital, all that stuff. And the number one thing is the lack of quality financial statements. There are a lot of contractors that don't know where they're making money or where they're losing money. And a good CPA, a good financial statement will pay for itself. It really will. So to maximize surety credit, just maintain profitability. You want to bid on profitable work. If you don't make money at certain types of work, don't do that type of work. Stick to where you make money. Avoid debt whenever possible. Don't overextend your capability and resources. Don't overextend your balance sheet. That's the quickest way to go out of business, is bidding more work than you can fund. Don't overextend your technical abilities or your available workforce, because then you're going to end up hiring people that maybe you wouldn't otherwise hire, and then maybe the quality of work isn't there. Being proficient at all trades is not as good as being the master at one trade. And you have people that want to kind of be good at everything. It's better to be great at something than be just okay at everything. Aggressively pre-qualify subcontractors. If you're in the general contracting business or you're subbing out any work, you got to make sure that those subs are able to perform the work, because ultimately you're on the hook for it if they can't. And aggressively manage your receivables, because cash flow is your lifeblood. It's no different in our agency. We've got to chase people around that owe us money and say, hey, you owe us money for 60 days. Can I get a check? We do it at our place too, and everyone hates making those calls. They're not comfortable to bug people for money. It kind of goes against what we were always taught. Don't ask for stuff like that. That's your lifeblood, and you got to keep your receivables low. Number one thing, though, align yourself with strategic financial partners, particularly people that make their living in your industry. So if you're in the service industry or the construction industry, have a CPA that works in the service and construction industry. Same thing with your attorney. Our attorneys aren't all the same. Somebody that writes wills and does estate planning is not a construction attorney. They're different. They're completely different worlds. Legally, they can do it, but it's no different than bonding and insurance agents. You know, you need people that make their living in construction, and that's what we do. Bankers, same thing. I had a contractor come up to me, and they're looking at refinancing and buying out a partner, and they brought 2 different bank proposals to me, and they said, what do you think? They're about the same. One bank I recognize is about on probably 1/3 of all my contractors at the agency. The other one I've never seen on any contractor in my agency. So take the one over here. They work with contractors. That means they know the ebb and the flow of construction. They know that there's going to be seasonal demands for more capital, and they know that you're going to be into the line once in a while and then pay out of the line. And they understand that you might have a bad year here or there. They get construction. This person over here that doesn't have any contractors, you might get one bad year and they pull the pin and they show up with a lock and put it on your door. So it's just different. So bottom line, work with people that make their living in your industry. Any questions on the bonding piece? All right, I'm going to pass off the microphone here and let Don talk about insurance here.
So insurance. What we're showing you here is currently what Travoux requires for a project that they've got going, the West Lawn project right now. Again, project requirements are sometimes a little bit different, but for the most part, they're very, very similar. So general requirements are the insurance company that you use has got to be AM Best, A-rated, or better. What that simply means is that they've got financial strength. If you've got your business with an insurance carrier that is about to go under, it doesn't do anybody any good. 30 days notice of cancellation is required, or 10 days notice for non-payment. When you provide that certificate of insurance to Travoux, you've got to have that 30-day notice so that they know that if you are going to be non-renewed or canceled for any reason, that they've got time or you've got time to reinstate the insurance or they will replace you. Must be maintained from the commencement of work until work completed and final payment made unless otherwise indicated. So you've got to have the insurance in place before you step on that job site. And it's got to be maintained until the project is over, until your work is completed or your final payment is paid to you. The limits of insurance, general liability, and this is true with almost any commercial project that you're going to bid, whether it be Travoux or anybody else, is $1 million limit per any one occurrence, any accident, any lawsuit that's delivered to you. At least $1 million for any one occurrence. The general aggregate, what an aggregate is, and typically insurance policies are written what they call an annual aggregate. What that means is that's the most the insurance company will pay in any one policy period. Being an annual aggregate, it's $2 million. So for example, let's say that you've been sued twice for $1 million and we pay out those claims. Your insurance is used up, it's gone. But a per project aggregate simply means that that aggregate applies for every job that you're working on. Much broader, obviously. $2 million for products completed operations. Again, that's your exposure after the work is done, during construction, and then after work is completed. In the case of Travoux, they required a two-year extension on your completed operations. Personal and advertising injury limit. Personal injury is like false arrest, libel, slander, things like that. Advertising injury, simply it's like a false advertising. You can't promote yourself. You're hired, and now you can't deliver what you said you could do. Travoux must be named as an additional insured. Additional insured meaning that you are naming Travoux on your insurance policy, so that should you screw something up, a construction defect, whatever the case is, and Travoux is sued, or Travoux is served with a from another insurance carrier, you've got to defend them. They're simply going to rely on you for defending them for your screw-up. On a primary and non-contributory basis, what that means is that your insurance is primary. Again, should you screw something up, your insurance is primary and non-contributory, meaning if your limits aren't great enough, Travoux isn't going to chip in. It's all on you. Waiver of subrogation, that means that your insurance carrier can't come after Trevaux to recover what they paid on your behalf. Product's completed operations coverage must be maintained for 2 years from earlier of 90 days from substantial completion or final payment. Again, like I said before, you've got to carry that completed operations out for 2 years. Per project aggregate applies. We talked about that. Again, your annual aggregate actually becomes a per project aggregate. Combined single limit, this is automobile, $1 million combined single limit each occurrence, or each accident, I'm sorry. And you might ask, well, why do I need why do they need my automobile liability and so on and so forth? Because your vehicle is most likely going to be on the job site. And if it's on that premise and there's an issue, Trevaux doesn't want to take the hit on your behalf. Again, Trevaux, named as an additional insured, just like your general liability. Waiver of subrogation in favor of Trevaux must be provided, again, just like the general liability, and must include hired and non-owned auto liability. Hired auto liability means that you're busy and you need some extra vehicles to deliver supplies or whatever the case is, materials to the job site, so you go to Avis and rent a truck. Well, that liability is covering the hired vehicle. Non-owned is covering employees' vehicles. For example, your expediter may be your project manager might be on the job site. He drives his truck onto the job site. Well, and there's an issue. Again, it's not an owned vehicle by your company, but that liability extends to the non-owned autos. Workers' compensation, statutory limits. There's two parts of workers' compensation. Coverage A, which is employer's liability, and then the statutory is for the recovery of injury, both indemnity and medical. Bodily injury, the bodily injury, each accident, disease policy limit, and disease for an individual employee. Again, coverage A isn't really applicable in Wisconsin. In some states, an injured employee can waive his comp benefits and sue his employer because his employer was negligent. Can't do it in Wisconsin. Okay, Wisconsin is a no-fault workers' compensation state. Waiver of subrogation in favor of Trevaux, again, just like the general liability and the auto liability. Umbrella, if your contract with Trevaux is under $1 million, you're only required to carry $1 million umbrella policy. And again, an umbrella policy goes over the top of your auto liability, general liability, and your workers' compensation coverage A liability. If your contract goes over $1 million, then you're required to carry a $5 million umbrella. Obviously, you're doing more stuff, a little riskier stuff, so they want to make sure that you're covered significantly. Again, Trevaux, named as additional insured on the umbrella policy, and also, just like the general liability, your insurance is primary and non-contributory. Proof of certificates of insurance, before you walk on that job site, Trevaux has got to have your certificate of insurance, and it's all got to be completed as required. Copies of additional insured endorsements and waivers of subrogation must be attached to your proof of insurance. I think we've got your certificate. We're showing the insurance carrier here. This is your agency or insurance representative. This is your company, and here's Trevaux. Here's the requirements that we talked about before. The waiver of subrogation, non-contributory and primary, naming Trevaux as an additional insured. Here are your limits. $1 million per occurrence, $2 million per project aggregate, your automobile at $1 million, your umbrella at $1 million or $5 million, and then your workers' compensation statutory. Now, the Housing Authority insurance requirements are a little bit less than most projects are. General liability is $500,000, auto's $500,000, professional liability $1 million if it applies to you. What drives the insurance requirements with Trevaux or any general contractor is, for example, with Trevaux, all their projects, most of their projects, are going to be HUD or WIDA financed. And they provide the insurance requirements that they've got to have. Trevaux's got to honor those requirements to get those contracts. There also could be private investors in some of these projects. They can drive the requirements of insurance. So it's not always going to be the same. Depending on what project you're bidding on, the insurance requirements could vary, but for the most part, they're going to be fairly consistent. So that's it. Easy stuff, right? Piece of cake. Any questions at all? Good. Well, thank you.